Okay, welcome to this explainer. Today, we're going to discover how a simple set of lines can completely transform your day trading from stressful guessing into structured, objective decision-making. You know, if you've ever felt like the stock market is just a random series of chaotic movements, you are absolutely in the right place. Today, we're decoding the central pivot range, which is a tool that can completely shift how you view price action.
Day trading can feel pretty chaotic, right? But what if there was a way to basically calculate today's weather forecast using yesterday's data before the market even opens? Just imagine sitting at your desk at 9 a.m. and already knowing whether the market is likely to explode in a massive trend or just chop sideways all day long. That is the exact edge that professional traders look for to keep their emotions in check. Enter the Central Pivot Range, or CPR. At its core, CPR is an objective intraday indicator that tells us if the market will trend or stay range-bound. Unlike traditional pivot points that just give you a single thin line to look at, CPR actually gives you a zone. It's a three-level range that acts as the heartbeat of the trading day. It helps you project exactly where the buyers are hiding and where the sellers are waiting.
So here is our playbook for today. 1. Decoding market direction. 2. The anatomy of the CPR. 3. Predicting volatility through CPR width. 4. Trend bias and price placement. 5. The Virgin CPR setup. And 6. Smart trading and limits.
Starting right off with Section 1, Decoding Market Direction, Finding the Anchor.
Let's talk about how CPR acts as this totally unmoving anchor in the frankly unpredictable sea of intraday trading. In a landscape filled with lagging indicators that change every single second, you really need something solid to base your decisions on. And this brilliantly illustrates why CPR is so powerful. It relies on objective, static numbers calculated before the opening bell even rings, which absolutely prevents those impulsive, emotionally driven reactions. Because the CPR is derived entirely from the previous day's data, those lines are printed on your chart the second the market opens, and they do not move. Imagine a high-flying tech stock that suddenly gets hit with a mid-morning news catalyst and just drops violently. While all your other moving averages are swinging wildly and generating noisy signals, your CPR remains your steady, unmoving reference point. It gives you true, reliable structural context.
Section 2. Anatomy of the CPR. The Rule of 3.
Let's actually break down the math behind these three core lines. Now, don't worry, you absolutely do not need a degree in advanced calculus for this. Your charting software is going to do all the heavy lifting for you automatically. But understanding the underlying mechanics is crucial for building trust in your tools. Basically, you simply take the previous day's high, low, and close to calculate your main pivot point, right? That's your average. Then you drive the bottom central and top central lines using that pivot and the high-low data. Together, these three lines form your complete daily range. By tracking exactly where the highest highs and lowest lows were yesterday, this formula essentially traps the market's previous momentum and projects it forward into today's session as a three-lane highway. Think of it like mapping out the exact boundaries of a playing field before the game even starts.
Moving to Section 3, Predicting Volatility, CPR width.
What's really fascinating here is how the literal distance between these three lines acts as your daily weather report. It's not random at all, it's highly predictive of exactly what kind of trading day you are about to experience. A narrow CPR? Well, that warns of a volatile storm and trending markets. When those three lines are squeezed tightly together, it means price was compressed the previous day. And as we know in trading, price compression inevitably leads to sudden, explosive expansion. So if you see a narrow CPR, gear up for a fast-paced day. This is exactly when you look for big breakouts and just ride the trend. On the flip side, a wide CPR signals calm, sideways waters. It means the market already made a massive move yesterday, and honestly, it just needs to take a breather. On wide CPR days, breakout trades will almost always fail. Instead, you'll want to shift your strategy to look for reversal trades at key support and resistance zones, buying at the bottom and selling at the top of the range.
Which brings us to Section 4, Trend bias and price placement.
Because, you see, knowing the weather is really only half the battle. Now you need to determine your bias by looking at where the price is actually placed relative to your CPR lines. Knowing whether the market is going to trend or chop is super important, but you also need to know whether the bulls or the bears are in the driver's seat. So the crucial point is pretty simple. If the current market price opens and sustains above the top central line, your bias is firmly bullish. In this scenario, the entire CPR zone acts as this giant trampoline of support, and you should be looking to buy on dips. Now, if the price opens below the bottom central line, the bears are fully in charge. The CPR becomes a heavy ceiling of resistance, and you should look to sell on rallies. And what if the price gets stuck inside the CPR lines? Well, that means the market is accumulating. It's a messy, choppy phase of indecision, and frankly, the smartest trade here is usually no trade at all until you see a clear definitive breakout confirmed with strong volume.
Okay, moving into some advanced territory with Section 5, the Virgin CPR setup.
Let's dive into this incredibly high probability setup that savvy day traders are just constantly scanning for because of its crazy reliability. A Virgin CPR happens when the price never actually touches or crosses the CPR lines during an entire trading day. Imagine a stock that gaps way up at the open and just keeps running on sheer momentum, leaving its CPR completely untouched in the dust far below it. Well, that untouched zone is essentially stored energy. It leaves that specific price level as an unbelievably strong support or resistance area for the very next trading session.
To put that into perspective, market statistics show that if a stock fails to reach its CPR range on the previous day, there is a massive 40% chance it will not break that Virgin CPR range the following day. I mean, that is a huge mathematical edge for a day trader. It essentially means that if price drops back down to test yesterday's Virgin CPR, it is highly likely to bounce right off it, giving you a remarkably precise, low-risk entry point for a really lucrative trade.
Finally, Section 6, Smart Trading and Limits.
Look, CPR is an incredible toolkit, but we really have to ground ourselves in the reality of its limitations. No single indicator is a magic crystal ball, and understanding exactly where CPR falls short is honestly just as important as knowing where it shines. While it does provide precise entries and brilliant risk management, it allows you to tuck your stop loss safely behind the pivot lines. Its static nature is absolutely a double-edged sword. Because it's based entirely on yesterday's data, it simply cannot adapt to sudden real-time news shifts that happen at, say, 1 p.m. today. That is exactly why you can never use it in isolation. You absolutely must combine it with other dynamic indicators, like volume or the volume-weighted average price, commonly known as VWAP, to actually confirm the price action before you ever pull the trigger on a trade. So, armed with the math behind the pivots, the powerful interpretations of narrow versus wide ranges, and that high-probability Virgin CPR setup, the only question left is, how are you going to incorporate this objective, pre-calculated data into your very next morning trading routine? By letting the previous day's data draw your map, you can completely replace the stress of guessing where the market will go with the confidence of simply reacting to it objectively. It's a real game changer. Take these concepts, pull up your charts, and just start observing how price magically respects these invisible boundaries. Happy charting, and we'll see you in the next explainer.